Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 278th VideoCast podcast for the week ending February 13th, 2025. Got a lot of great stuff to cover today. First, we'll do a little bit of family and life stuff. So that was me this week yesterday at the New York Stock Exchange. Pretty exciting, never gets old. That's in front of one of the studios. That's with Kristen Scholler up in the booth. We did a great segment together. That's with Diane King Hall. She used to be at Yahoo. She's now at Schwab Network, and more there. And then this was the crew, ladies and gentlemen. We like to get together for dinner every few months when we're all in town. You know these faces from Fox Business. Lou Bassanese, obviously Kevin Mann, Adam Johnson, and you've got Kenny Polcari, you got John Lotsky, you've got Mark Tepper, and you have Greg Farinello. We just had a wonderful time. Brazilian Steakhouse, great time. Then on Tuesday, I had the chance to join David Asman on Varney & Company. Want to thank Preston Mizell, Christian Dagger, and co., and obviously Stu Varney for having me on for that segment. We're going to listen in here.
A group led by Elon Musk has made a bid to his former partner for a takeover of OpenAI. I love this story. How much is the offer
I couldn't believe it when I heard it last night. So the Wall Street Journal says it's a $97.4 billion bid. It's for the nonprofit that controls OpenAI, the maker of ChatGPT. And the timing. This is coming right when OpenAI is transitioning to a for-profit company. And Elon Musk is trying to stop all of that. So the OpenAI CEO is Elon Musk's arch rival,
who was
Sam
his former
Altman.
partner, by the way.
They founded this company together about a decade ago. So Sam Altman responded to this unsolicited bid by Elon Musk on X saying, no, thank you, but we will buy Twitter, which is now called X, for $9.74 billion if you want.
He just moved the decimal point over one point.
Right, and he's saying you've done nothing with this company. But that $97.4 billion offer for OpenAI, doesn't that seem cheap? I mean, considering with the latest funding expected to come in, it's valued at about $300
I think he was playing with that just to kind of put it in your face, Elon, take your money and shove it. All right, Lauren, thank you very much. Tom Hayes joins me now. Tom, I do love it when billionaires have these spats, particularly ones that were former partners. I wonder if some of it, though, is being made up just in order to get attention for what they're doing.
Well, this is high-stakes poker for sure. Elon Musk does not want to see SoftBank's $40 billion investment at a $260 billion valuation, so he offered a third. So SoftBank will have to go back to their shareholders and say, no, it's really worth $260 billion. It's not worth $97 billion. And Sam Altman going back, well, you paid $44 billion for X. Maybe it's only worth $9.7 billion. So I think this is just back and forth, but the stakes are high. What he should be doing is making an offer for DeepSeek and getting that model at a discount, a significant discount to what they're doing at OpenAI. You've got faster models. You're seeing it with Alibaba.
Well, if you believe them, there's a lot of these models from DeepSeek are now being questioned whether they're as good as they've claimed they were.
That's fair, but you have competition from Alibaba. Qwen 2.5 is showing faster performance in against DeepSeek, et cetera. So there are a lot of models coming from all over the world. Stakes are high. Everyone wants a piece of this pie.
Lauren, you want it in.
DeepSeek, Elon Musk, those are the open source models. And Sam Altman is closed source models. So I hear the argument you're making is for the open source, which might be the way to get everybody on board and make this stuff move faster.
Next one, Tom.
Even if you break things.
Does the threat of the Trump tariffs change your investment policy at all?
Yeah, I think what we're seeing, Trump is trying to even things up. Our simple average tariffs are 3.3%. If you look at India, they're 17%. If you look at Brazil, they're 11%. If you look at China, they're 7.5%. So he's trying to even things up. What's this going to affect? Steel and aluminum. It's going to affect heavy machinery. It'll increase the cost for Caterpillar, Deere. It's estimated.
And that's why the value of the stocks, the U.S. stocks that are in aluminum and steel, have been way up over the past couple of days.
Yeah, in terms of the steel producers, that's going to help our national security, et cetera. In terms of the impact to the finished goods, Caterpillar, Deere, a lot of this is already priced in. They're not down that much this morning, and that's a good thing.
Tom Hayes, great to see you. Thank you very much for being here. Coming up.
And we're back. Then I had the pleasure to join Oliver Rennick and Tom White on Schwab Network to talk some Alibaba. Thanks to Heidi Schultz. We're going to listen in here.
All right, we're looking at stocks here, trying to catch a bid this morning. Let's keep talking sell-offs and dip buying opportunities. One of them has been in China as the trade starts to firm back up. Joining us, Thomas J. Hayes, Chairman and Managing Member at Great Hill Capital, and Mr. Tom White here with me in studio. Thomas, you're looking for dips to buy. The China dip had really been there the last year. Is it starting to come back?
No question about it, Oliver. Thanks for having me. We've been in BABA for almost 2 years now, and we are more investors than traders, so we've bought in the hundreds and we bought a ton in the 60s. So our base is around $83. This is an absolute no-brainer. We look at intrinsic value, we think is well in excess of $200 per share. This is the #1 cloud provider in China. Obviously, you had the announcement yesterday that Apple is going to be using Alibaba's AI for Apple Intelligence, which was big news, but only part of the story here. Complete play on the middle class recovery with Taobao and Tmall as the 1.5 years of nonstop stimulus is starting to kick in the economy. International growing at 40%. So there are a lot of, if you play poker, Oliver, there are a lot of outs, a lot of things to love in Alibaba. And, it's had a huge move in the last few weeks, so probably consolidate for the next few weeks, but any weakness in the coming months is an opportunity to buy for the long term in our view.
Love me some outs, but I also like equity and getting my money in good. Is this a draw? You need something to come to fruition here? Or is the trade past 120 basically a breakout? Because that's a level that has rejected Alibaba time and time again, basically, 120.
Yeah, look, we were buying Alibaba before it was cool with David Tepper, and he put 37% of his portfolio in China. Certainly the 120 level has been a problem. Maybe we knock on the door again and don't get through for a few weeks, for a couple of months. Take that weakness, because once we get through, they're not going to let anyone in. This is going to go to intrinsic value. This is a theme. We've seen this theme since July of last year, broadening. What have we seen at the beginning of this year? Europe equities outperform U.S. equities. Equal weight have outperformed cap weight. Mag 7 earnings growth is decelerating. And guess what? China tech has outperformed U.S. tech by a wide margin this year. We believe that trend is going to continue. And what most people don't know is that's exactly what happened in Trump 1.0. Everyone thought Chinese stocks would do horribly. If you look from 2017 and 2018, one of the biggest runs in the shortest period of time in Alibaba, in Chinese tech, et cetera. So we really like the runway moving forward. Any consolidation next couple of months, great opportunity for the long term. Some of the parts, in our view, well over $200 a share.
Such a good point, too, on how China performed. We were hearing that from our own Jeff Kleintop, Tom, about international outperformance, both on the year and the way China traded in the first Trump term. You got a BABA trade. Tell me what you see in the options, Tom.
Yeah, well, they've got earnings next Thursday, so that's going to be a key point to take a look at. Maybe some weakness after the gains that we've seen so far this year, up 18% just in February. So it's had a great run already. So I looked at something a little bit more conservative in the option side, trying to take advantage of that higher implied volatility level that we're seeing in the shares after this run up and the earnings event. So going out to that February 21st monthly cycle, so just 9 days to expiration, I'm going to sell an out-of-the-money put vertical to take advantage of a neutral to bullish type stance here, where I'm going to sell the 110 strike put and then buy the 105 strike put. You want to stay risk-defying going into this event risk with earnings. $5 wide short neutral to bullish put vertical, collecting roughly about $1.30 credit on it. That's what you can make on $130. You've got about $370 in risk on that one, but it takes your break even all the way down to 108.70 to the downside. That's about 7% below the current share price. So you're giving yourself that cushion to the downside where you can profit in 3 out of 4 scenarios on this move. But this is a really short term, just a trade to take advantage of that higher implied volatility.
Okay. So there is still a good bit of volatility in here in the premium.
Yes.
which, I mean, makes sense. This thing is moving fast.
Yep, and earnings next Thursday. That's going to be key.
Okay. Man, 80 to 116 in a hurry this year for Alibaba. What a wild chart, by the way, that kind of U shape, almost a V from the October highs, and now back to them. Hey, Thomas, one other one you like here, I want to make sure I get your thoughts on, is PayPal, which has come off, and it's done it around earnings. Pretty big gap down on the last report. What'd you make of that, and does it concern you at all?
Yeah, same exact story. We've been in this one for a while, buying every single dip, basis $62. It ran right up to $90. Alex Chris is an unbelievable CEO. Came from Intuit. He's applied a lot of those same strategies. The reason the stock sold off on earnings was the market was upset that they feel that growth is slowing. It's not slowing. He's firing unprofitable customers because he wants to generate free cash flow and buy back stock. They did $6.8 billion of free cash flow in 2024. He's sandbagging again in 2025, setting expectations low, $6 to $7 billion of free cash flow. If last year is any prologue in terms of his sandbagging, they'll probably do $8 billion of free cash flow. Look, this is a $75 billion market cap. They just announced they're going to buy $15 billion worth of stock. They're going to buy in 20% of the company. They've got Venmo as a verb. They've got Fastlane Checkout that's doing phenomenal. This business is going to be great. Great leader, great turnaround story. It'll be back up to 90. We estimate intrinsic value up around 120. It may take a year to 2 years to get there. This is a high quality, durable, growing business that's generating cash like it's going out of style.
Convincing, and I like to hear it because my narrative on PayPal has been pretty similar. I was kind of confused why the stock was so hated for basically, 18 out of the last 24 months. So it seems like it has totally revamped the way we bank and the way we move money around. Thanks a lot, Thomas. Appreciate the conviction calls and the details there. And of course, a nice poker reference, always a good way to get on my good side. Tom, give me a PayPal trade.
Well, I know why the stock was down, because their users across all their platforms was actually decelerating. But as Thomas mentioned, the new CEO, Alex Chris, is making some solid changes and good partnerships here. So I looked at something a little bit more aggressive here, but giving myself duration. The stock's pulled back about 11% so far this year after that poor earnings report. And it wasn't a bad report. It was just poor guidance and maybe some profit taking after that big run up. But I looked at something a little bit more aggressive, going out a couple months to the April monthly cycle. So you've got about 64 days till expiration on this one, where I'm going to buy the at the money 75 strike call, and then to offset some of the costs, because maybe it goes up, but maybe it just doesn't explode back to $90, sell the 85 strike call. So a bullish $10 wide call vertical to the upside. You're paying roughly about a $3.40 debit for that. So that's going to be your risk on that trade. Takes your break even up to $78.40 on this one. That's only about 4% above the current share price. So you don't need a monster move to the upside. You just expect over the next couple months that we're going to start making up some of those losses that we've seen post earnings on this one. But pretty straightforward. And because you're buying the vertical, Oliver, you have a little bit more flexibility as far as trade management. So if the stock does pop up towards, above $80 a share, and this thing expands to maybe double, you can start taking off parts of your position or the entire position ahead of expiration. You don't have to wait for it because you're buying the vertical, and it gives you some flexibility.
All right, buying a call vertical, buying upside in Baba, buying it in PayPal, and taking advantage of volatility where it's elevated. More elevated in Baba, it seems like. Okay, thanks for the trades.
And we're back. And then finally, I had a chance to join Kristen Scholler. Always have great interviews with her. General market overview, couple picks. Want to thank Mel Montañez, Jeff Cohen for having me on. We'll listen in here.
Joining me in studio is our market expert today, Thomas Hayes. He's the chair and managing member at Great Hill Capital. Thomas, great to have you.
Great to be here, Kristen.
So a lot to digest, of course. Choppy but higher start to the year. Now this inflation report, stocks set to drop about 1% at the open. What are the takeaways?
Well, I think a couple of things. I think Goldman Sachs and JP Morgan set up the street. They said if it came in this hot, the market was going to be down 1.5% to 2%. It's kind of consistent with the February seasonality. This is the second worst month of the year historically, and in a post-election year, February is down on average 1.3%. So I think we got to buckle up, Buttercup. This might be a little bit of turbulence here for the next few weeks. There will be a knee-jerk reaction to the inflation report. 10-year yield was at 480, went down to 450. Now it's back at 463. Do we go back and test 480 again? Maybe, maybe not. We're not going to 5. Bessent and Trump have already said they want to target the 10-year yield. So I think actually what you're going to see before we get to 5, we might actually move to 4 because there are deflationary actions in place, namely with Doge. They are cutting costs with a machete. They're laying off a lot of people. That's going to be deflationary. That's going to hurt the jobs market a little bit. That will offset, but we're not going to see that right away. So right now, it's an immediate knee-jerk reaction to inflation, and we're going to see that today.
Yeah, so just in about 2 hours, 1 hour, I guess, we'll hear from the Fed chair here on the East Coast. But I am curious, Thomas, how tariffs factor into this, because since the last time we spoke, we have heard a wave of tariffs announced by the administration.
Yeah, if you look at the effect of tariffs historically, you do get a short-term pop in prices. Intermediate term, it normalizes. And actually, if you look at washing machines and so on, shortly thereafter, actually prices are lower a couple of years out. So it's kind of a short-term impact in terms of the tariffs. Again, volatility that we're going to see here with the new administration, and new headline every day. Welcome to Trump 2.0, same as Trump 1.0, a new tweet, a new set of volatility.
So let's talk about some of your picks within the backdrop of this market.
Yeah. So when we came on early this year, we said that this is going to be a different type of year. Mag 7 is not going to be the leader. We're going to see broadening. Well, what has happened in the first 6 weeks here? The 493 equal weight has outperformed the Mag 7 cap weight, so that's new. Europe equities have actually outperformed U.S. equities, and value has outperformed growth. 3 things that weren't on most people's bingo cards, but they heard it right here on Kristen Scholler's show live at the NYSE. So that's going to continue. So what's up next? I think what could be up next is small cap starts to outperform large cap, and emerging markets start to outperform developed markets. Why? Because you're getting earnings growth for lower multiples in all those areas that are starting to broaden out and starting to outperform. This inflation report is going to be an opportunity for dividend yielders. So yields are going to blow out. They're going to get sold off in the next couple of days, and then you want to buy some of these defensive stocks. One that we like is Crown Castle. It has a 7% dividend yield, 40,000 cell phone towers. They are a leader in that business, but what's been holding them back is their fiber business is very capital intensive, takes a lot of investment and a very low return on that investment capital. They're selling that off to Zio Group for $8 billion. That'll enable them to buy back stock, pay down debt. It'll be a great thing for shareholders.
7%, pretty impressive, right? Especially in this environment where high yield savings is maybe yielding you 3.5%, and bonds would be lower as well.
Correct. And you have capital appreciation potential once they get rid of that albatross around their neck. This stock can really move up quite a bit. So you get paid while you wait. You get some capital appreciation over the next 2 years. The next couple of days, use this opportunity to take advantage.
What does this mean for deals?
Yeah.
The overall market.
Look, this market is primed for a lot of IPO paper in the next 12 to 24 months. In the short term, you're probably not going to get your deal out in the next couple of weeks. We're going to have a little rockiness, a little bit of volatility. Another defensive stock that we're looking at in this context is Hormel, the maker of Spam, of all things, Spam, Hormel chili, all the protein snacks that people need, whether they're just normally eating or whether they're on GLP-1s, which is the new trend. They want high protein stuff, Skippy, Planters, etc. This has been kind of mismanaged since 2016. That CEO is leaving, Jim C. It's got a 3.7% dividend yield, and they've been raising the dividend every single year for 59 years. It's a dividend aristocrat.
Now, that is a serious track record, right?
That's right. 59 years is a long way.
So let's talk a bit about bonds. Thomas, I know you mentioned, obviously, dividend stocks.
Yeah.
How do bonds look to you at these levels?
Yeah, so I think you'll get this knee jerk. You're going to get an intermediate term sell-off right now. 10-year yield's probably going to go back up to 480, somewhere in that neighborhood. any weakness in bonds is to be bought. Okay, the deflationary forces of Doge and cutting and et cetera, and the slowdown that could be short-term impact of tariffs, you get a slowing of growth as well, will be an opportunity to buy bonds. Right now, there were two crowded trades coming into this year. Number one was long Mag 7. What's been the worst performer? Mag 7. The second most crowded trade is short bonds. Everyone's shorting bonds in the hole. Today they're going to feel smart. In 4 weeks, they're not going to be so happy.
Interesting. Yeah. So would you buy the dip?
In bonds, for sure. In the next few days, I'd be buying bonds left and right.
If we see underperformance in February, historically, which is what happens, what about that for equities?
For equities, for sure. This is where you want to get out your shopping list. In the next 2 weeks, you're going to have opportunities to buy great businesses. It's no impact. This will be a tiny little blip on the screen when you look back three months from now. Use this as an opportunity. This is how you make money. You don't sell in the hole. You buy in the hole when you're buying high-quality businesses, Kristen.
Thomas Hedge, Chair and Managing Member at Great Hill Capital. Thomas, always a pleasure, and thanks for joining me in studio.
Thanks for having me.
Great to have you.
And we're back. So now you have pretty much the general overview. Finally, want to thank Shahjawat Chauhan and Sukriti Gupta for including me in their article on Reuters. And let's get to the quotes of the week. This is from Peter Lynch. When stocks are attractive, you buy them. Sure, they can go lower. He says, I've bought stocks at $12 that went to $2, but later went to $30. You just don't know when you can find the bottom. The key is knowing the underlying fundamentals, knowing what you own, which we cover every single week. Charlie Munger, the big money is not in the buying or the selling, but in the waiting. We're seeing that play out with Alibaba for sure. And then Peter Lynch, the trick is not to learn to trust your gut feelings, but rather to discipline yourself to ignore them. Stand by your stocks as long as the fundamental story of the company hasn't changed. So we're going to cover some of that. Let's get down to economic market data here. Missed a couple photos here. This was Mimi trying steak tartare for her first time ever at Eddie V's, which was best steak tartare I've ever had. Didn't think that was going to happen. That's in front of the New York Stock Exchange. That's in the Varney studio. And that's with my buddy Kenny Polcari. I got to do his show on Yahoo Finance. That'll be out next week in front of Fox on the desk at Varney & Co. So I share that for the new people tuning in for the first time, give you a behind-the-scenes look. You can see here I look the best in this photo out of all of them because of wonderful Yasha works her makeup magic on me, and we got to talk about all different brands. You can guess which brands I asked her about, which she was pretty upbeat on, which is pretty good to see. Okay, let's get down to data. Analysts are raising European earnings forecasts. Value has outperformed growth. And Europe has outperformed the U.S. and 493 has outperformed Mag 7 so far this year. This has been a theme. We've been pounding the table when it was unpopular. Now everyone is coming on board, and that's the beginning of a trend. You can see these Mag 7 mania question mark. You can see previous bubbles, whether it was oil, whether it was home prices, whether it was the NASDAQ in 2000, whether it was the Nikkei in the late 80s. Gold in the 70s, Nifty 50 in the 60s, etc. It doesn't mean that it's going to crash down like all of these did. It just means that there may be better places for outperformance in the next 12 to 24 months, and that's been our theme. We started pounding the table in Q4. A lot of you came in early this year, and I was, I never promote, people coming in. They come in or they don't come in. It makes no difference for me. I eat one cheeseburger a day. It's fine. But a lot of you came in for Q1 at the right time because I emphasized it, and it's just been a rocket ship right after the inauguration based on how we're positioned, not for the general market overall, and that's pretty exciting. So, and for existing clients, also super duper exciting. So, percent of S&P 500 total market cap with price to sales greater than 10x. Again, this points to some of the extremes, like I just shared on some of those previous historic bubbles. This was basically, if you go back, 100 years, this was the only decade where you could buy a basket of stocks trading at 10 times sales and actually outperform the S&P 500. Historically, every decade, it's pretty much a guaranteed way to lose 90% of your money in 2 to 3 years. And that was a function of ZERP. We're not going back to ZERP anytime soon. You saw the inflation numbers yesterday. However, January of the last 2 years is a surprise to the upside, so don't expect that to persist. You got a lot of people getting laid off with Doge. There are going to be counter-trending forces, but we're not going back to zero interest rate policy. Moving along, PE, S&P PE ratio on a trailing 12-month operating EPS. Again, going back to 1940, growth versus value extremes like we saw in 2000, 1940, and 2022, just before we had the tech crash in 2022, where we were able to buy Alibaba and Google at huge discounts in October 2022 when no one wanted them, sell them at easy doubles. And then now we're getting back to those extremes. So here you go. A lot of people are coming on to our point of view. Why? Because the price is down 20% on a lot of these names. Opinion follows trend. They didn't tell you ahead of time. They told you after the fact. But better late than never, I guess. Total returns, 2000 to 2006. Small cap value, 16.6% annualized, 185% cumulative returns. I think we're setting up to an environment just like this. Small cap has not outperformed large cap year to date yet, even though Europe has outperformed US and 493 has outperformed Mag 7, and all the other things are starting to play out. I think that's the next phase. I think emerging markets is already happening. China tech is dramatically outperforming US tech, US Mag 7, and up until a day or two ago, tech was the only sector in the US negative or flat on the year. So, seeing healthcare, remember the last shall be first. Some of the materials are starting to perk up, etc. Also during that period when Amazon was dropping 80%, 90%, Cisco was getting bashed, Enron, WorldCom, all the darlings, Global Crossing, value was up 69% during that period. S&P did fine because the weights came down, but underperformed, getting the right exposure with small cap and international. This table doesn't have international, but dramatic outperformance in China during that period. And I continue to reemphasize these themes because, number one, it's working, and number two, it's just math and understanding everything is cyclical. And if you pay attention to extremes rather than chase them, you can make incredible returns over time. So post-election year seasonal pattern. This is when we get the chop, the second half of February. Hang on to your horses. That might be in the indices. It may not necessarily be in all the names, but don't expect miracles. I mean, we've had some really big down days in the market the last 6 weeks, and our portfolios have been up on those days. So we're just positioned perfectly so far. But February, June, September, you got to expect drawdowns, and that's just the way it is. And you just hold your businesses. If you liked them 2 weeks ago, you're going to love them in the next 2 weeks. So evolution of Atlanta Fed GDP. Now, it's interesting about Alibaba. It actually shot up to like 127 overnight. So it broke through that 120 barrier. And I was thinking, wow, well, I'll take that. I mean, I was on the morning before saying, hey, we're, knocking up on this 120 here. Don't be surprised if we consolidate these gains for a couple of months and shake out all the people chasing back up at 120 and scare them out at, low 100s or 110 or something like that, just like every single move. And then once we break through 120 materially, just, they won't let anyone in, is what I said on Schwab with Oliver and Tom. And we just busted through it last night, came back in this morning, I think finished up pretty strong, looks like about, 119 and change. So I would not be shocked if we consolidate that, because a lot of people chased up overnight last night and got smashed. They're down 10 points already, so they'll be panicking out of their FOMO margin, and that's that. So don't worry about that. Everything is on track with that theme. Evolution of Atlanta Fed GDP now at about 3%, not stuff you see in recessions. Here are the cycle composites, 1, 4, and 10 years going back to 19. Let's see. It's probably going back to 1950. And this is that chop in the second two halves. So a bunch of stuff pointing to that, but we told you that in the last few weeks. So just be aware, and when it happens, don't be surprised, and just sit tight. Nothing's changed to the underlying businesses. AFC winners have been good for the Bulls lately. Yeah. This is an after the fact thing. Before the fact, they said if Philadelphia wins, it's going to be the end of the world. It's coincident, not causal. I hope you don't believe it's causal, or my condolences to your investment career. Progression of Magnificent Seven quarterly sales surprises. This is something that hasn't happened since 2022 when you had the tech wreck, which is you had 0% of sales surprises. Okay, quarterly sales surprises. So in aggregate, so that's a thing. And then Magnificent Seven year to date was negative 30 basis points, while the XMag 7 was 2.8%, and the S&P 500 2.7%. This actually got more extreme. What date is that? As of Anyway, and then you can see here what we cover every single week. S&P earnings growth of the unmagnificent 493 is growing. Mag 7 is decelerating. Multiple is still too high. Hasn't derated enough yet, whereas this multiple is low and should start to play catch up and re-rate over time. The outperformance of the Magnificent Seven has historically reflected its earnings superiority. 2025 bottoms-up estimates imply excess earnings growth will narrow for the Magnificent Seven, 32 percentage points in. It was 32 percentage points excess in 2024 to only 6 in 2025 and 4 in 2026. So decelerating earnings growth, huge premium multiple, 33 times versus 22 times for the S&P versus maybe 18 times for the XMag 7 or equal weight. And then if you look at small versus large, international versus domestic, the spreads are even larger, and the chickens are coming home to roost, and we are gathering chickens like it's going out of style. Is the tide turning? Returns through 2/5/2025. This is Europe versus the S&P 500. Dramatic outperformance. It looks like about 7-8%. Looks like about 3-4% outperformance already year to date. Percentage of international buyers in Los Angeles County. So this is Chinese buyers parking money. You can see this is starting, this peak during COVID, this is starting to diminish. I think this is going to diminish even further. It's funny, when we bought a house out here, I said to my wife, I was like, so you want me to buy the top in Orange County and sell the bottom in Connecticut? Maybe you haven't been paying attention to what I do for a living for over 2 decades and how we have the ability to do all this. But we played the smart game. We rented out Connecticut so that I can appreciate the houses there, and we got a nice situation here. But I think that Orange County real estate, it passes any prologue looking back to the Japanese and the Orange County housing crisis in the early 90s. I think what's happening now is the Chinese were panicked when they were in lockdown, getting their money out any which way they could. Easy way to park it. They got a ton in Los Angeles, but even more in Orange County, Newport particularly, in the nice areas. And most of them are empty. It's just a store of value for them with a negative carry. And I think as equities take off and they see new opportunities, and the regulation has come back down, and the stimulus has gone up, I think they're going to get serious FOMO. FOMO is a universal thing. It's not by nationality. It's a human condition. Most people get the FOMO gene. I was blessed not to get the FOMO gene. And I think the marginal Chinese buyer parking their money is going to be less incentivized to get money out of China in the next year to 2 when everything is going up. Property's recovering. You're going to talk about some of the articles. Stock market's recovering. They're going to want to make these incredible returns. And like everyone else, opinion follows trend. Now they're going to get excited about China. So it's not that they're going to sell everything and bring the money back to China because it's so hard to get out, but the marginal buyer is going to continue to decline. And once that final marginal bid evaporates, it's a huge air pocket. And so we'll see what happens, and there could be interesting opportunities in the next few years out here. Bank of America, bull bear indicator, not what you see at extremes. Here is the multi-year twin peaks in long-dated treasury bonds. We've covered this. This is the most important point. In my view, these dollar and treasury fake outs are going to get reversed Bessent and Trump have said as much. They're going to focus on that. Doge is moving ahead at a breakneck speed. They're laying off a lot of people, a lot of people taking packages that are not necessarily going to be absorbed by the private sector, because they probably don't have a decent portion of them don't have transferable skills to earn commensurate income, and they're going to think that anyway. The point is that their deflationary forces intact, which is going to be very good for bond yields coming down, which is going to be very dollar coming down, which is going to be very good for international. Tariffs here still at 100-year lows, went up for 12 years before you saw Smoot-Hawley. So people who keep pointing to Smoot-Hawley haven't read history books. You had 10 years of prosperity with tariffs increasing. Reciprocal tariffs is a great idea because the net effect is most people are going to want tariffs to come down. So rather than our tariffs going up, theirs are going to come down. It's going to be more free trading and better for velocity of money globally, which increases the standard of living. China, less reliant on U.S. exports today, so they're not, it's only 2.8% of their GDP, so they're not going to really be bullied. You saw them do the reciprocal tariff, so I think there's going to be more incentive to cooperate versus not talk and blame like the previous administration, which caused an awful lot of problems. And the most important problem that it created, in my view, is DeepSeek, because once you block them from having chips, necessity is the mother of invention. Now they're independent, and on many metrics, they're outperforming us at the moment. That won't necessarily continue, but they will have something comparable where they can compete. And we saw it in Alibaba's announcement, etc. AI capex, relief for semis. You see Intel going straight through the roof with J.D. Vance's comments, which is pretty exciting. Weak demand are tracking at the lowest level in over 2 years, so that's good. Mentions of a bottom soared in 24% year on year, the biggest jump in history. So those are the type of things you saw at the COVID lows, at the great financial crisis lows. And this is, by and large, the 493 companies, the unmagnificent 493, are the ones saying mentions of a bottom. So that's positive for the rest of the indices, which means you could see subdued index with still the overweight in Mag 7, but the rest of the companies doing extremely well, not moving the needle on the indices for all the people that are crowded into the crowded passive trade, but really exciting for the people in the active management. Earnings are expected to broaden out from here. We see the data here. Percentage of stocks outgrowing the Mag 7 is climbing again in a material way, just like you saw in 2020 and 2021, which is an awesome time. And also in 2014 through 2000. This doesn't really go back far enough, but it's a positive thing. Again, I can't reemphasize this chart enough, ladies and gentlemen. Decelerating earnings growth, Mag 7, accelerating earnings growth, 493. And similar situation in terms of prices, what you pay, values, what you get, international versus U.S. That cycle is going to come back. We've shown that chart a few times. Hyperscalers, capex growth to remain strong in 2025. People view that as a positive. The problem is in the intermediate term, call it 2 to 3 years, we're seeing 0% return on invested capital. And what it's doing is it's crowding out money for buybacks, which has been a huge part of the stock growth. And it's lowering the return on invested capital, which is forcing analysts to start to think re-rating. Now, it may be true that 5 years from now, they are going to have a return on invested capital like none other. But right now, for everyone thinks that this is the opportunity of a lifetime, this is FOMO defensive spending not to get left in the dust. They don't know what the return is going to be or how it's going to be. My guess is it will be great, but it will be many years out. So in the meantime, like when you saw Meta go down to $80 when Zuckerberg was going to spend billions on the metaverse, once shareholders saw that there was no return, they basically revolted, and he finally got the message and he flipped around, and it's just been a home run ever since. Hyperscalers capex as a percentage of operating cash flow is expected to remain high. Again, that's going to impact margins, return on invested capital, and ultimately the multiple. CEOs expecting higher capex over the next 6 months rose to the highest level since Q4 2022. This is part of our manufacturing recovery theme. Manufacturing has been in a depression for 2 years. Mag 7 stocks haven't been able to keep pace with the broader market so far. And we think at the end of the year, we'll look back, that will be the case for the full year. Chinese investors snapping up Hong Kong stocks. That was part of our core thesis with the dual listing, that the Chinese were going to be able to buy more and more through the Stock Connect. That has been the case, especially for Baba, just rocketing overnight. I'd love to see it just hovering here between 119 and 108 for the next 2 months and just scare everyone out and get phone calls like, oh, is it going to hit the resistance again? Blah, blah, blah. While the fund is, so maybe earnings, they'll be conservative, and that'll be the excuse for it to trade down for a little bit, knock out the weak sisters one more time, just punish them again, and then straight up to a much, much higher level. So excited for that. Year-on-year growth in the S&P cash use. So you can see here a massive decline in buybacks relative to capex. This is going to hurt EPS on the Mag 7 because that's where all the capex is. Bottom-up consensus expects narrow Mag 7 versus 493 earnings growth gap. So we covered this already. You can see it was 33% last year. Mag 7 outperformed in terms of earnings growth to the 493. And that starts to narrow. The problem is the multiple hasn't narrowed. Mag 7's 33 times, maybe a little less now. Mag 7, call it 18, 19 times, and a lot of them a lot lower, and accelerating, closing in earnings growth. Moving along, PE valuations relative to history. So you can see kind of where there's the greater growth, a greater opportunity in terms of the spread, and then the absolute. So the relative multiple and then the absolute multiple. The absolute multiple, they're basically saying real estate and energy are the only bargains. The relative multiple, staples, I see a lot of opportunity there, which is why I talked to Kristen about a staples name. Materials, same story. Healthcare, all the things that we've been preaching about. If you believe in value for money, here's MSCI China trading around 10 times multiple, down from 20 times at its peak. And here is S&P 500 trading at, it looks like about 24, 25 on the basis of this Bloomberg chart. China's tech firms staged a rebound this year. That actually broke out to new highs overnight. Here's from Ryan Dietrich. Again, if stocks break the December low, it's a warning sign like 2025 did. So what he's saying is the average return in years that they broke, which we did because of the Mag 7, average return is flat to negative. So negative 20 basis points. I could see that. I could see Mag 7 being negative, bringing the indices to flat, and some of the other names being up 50, 100, 150%. That are beach balls underwater. I mean, Baba's already up, 50% in the last couple of months. So healthcare single stock flows flip positive. We talked about that. Last shall be first. Same with materials flipping positive. Value ETFs outpacing growth ETFs. Everything we set you up with before the end of the year and told you we were going to do is now happening. This actually broke above this level meaningfully last night. And I think is still holding there, by the way. But I would love to see after earnings just grind for a couple of months in here and really just take any possible believer, all these weak sisters that just bought up here overnight, 10 points. I mean, 10-point move overnight. I was at the airport just laughing. I was like, these guys are going to get shellacked. And so there you go. Chinese cloud-based lag, U.S. peers in growth. So you can see Alibaba Cloud Intelligence growth ratio is growing basically the fastest. Microsoft and Amazon have been flat. Their growth rates, Baidu has been going down. Amazon is picking up share. Alibaba Cloud Intelligence is picking up share in the Chinese cloud business growth, which is exciting to see. And then, and it's still early days. They're 5 years behind us in terms of just basic digitization and compute. Core CPI, auto insurance, and shelter have contributed to the rise. If you take that out, which I don't know, you get to 1.9%. This is from Tom Lee over at Fund Strat. It's like, if you take everything out, you get to 0. But there you go. U.S. inflation rate. But I like how he breaks that down. Very useful information all the time. And he again, just a reminder for those of you who are new, literally there were like 3, 4, 5 people that were publicly bullish in the hole in October 2022 when everyone was selling in the hole. The biggest billionaire hedge fund managers, and I don't even need to say more than that for you to know who I'm talking about, were telling people to sell when the market was down 27%. Unbelievable. And we were on this every week telling people to buy. And I'm not saying that for a pat on the back, because I don't get everything right. And you know that I get some right, I get some wrong. But usually my wrong is just time. It takes longer than expected. And sometimes it happens faster than expected. And I'm wrong on that front. Like, I have these new people that came in first quarter and they're smiling so wide they can't believe. And I was like, listen, this is, yes, we said this was probably going to happen, but, don't expect this all the time. I mean, it's not going to happen. You're not going to have, months like this all the time. But the key is knowing the underlying business and the businesses that you own. And that's why great things happen. And for outperformance, anyone who gets linear returns can't outperform. It's lumpy. And when it happens all at once. You can get 3-4 years of returns in a good year. And in some cases, a lot more than that. And then the other years you're moping along, and then boom, you just get crushing, unbelievably outperformance, and that gives your IRR great things over the 3 and 5 year windows, which is what everyone really cares about. So we're there now. So that's what's happening, and people are surprised, and I'm not, because I've been on here every week with you saying this is going to happen, and this is what happens, and that's that. So. Core inflation, we saw the inflation numbers again. We talked about what, Doge, there are other factors, seasonal factors, and policy factors that are going to offset that. European stocks see best start to year since 2000. What was our key theme? International outperforms domestic. And what was the year that we kept pointing to? 2001. And here we go. Europe trades at a record discount to the US. Okay, so we've got our GXO, which, is a shit show after hours. Let's just call it what it was. You got 3 problems there. Number one, you got to get the CMA announcement to clear it. I've never seen a regulator try to regulate a deal after the deal is closed. I mean, you can't even make this stuff up. A bunch of socialists over in Europe. But nonetheless, we'll get an announcement on that in the next week, they said, on the earnings call. So we'll see what happens. And then you're going to need the new CEO announcement is going to be another catalyst. And then from there, look, the business is doing well. They had a couple clients take down space, but then open up space elsewhere. I like it. It's absolutely fine. We didn't do anything today. We're going to take a few days, let it settle out, see where it is. We added a ton at 42 when it dropped after the deal was called off. And we'll make a determination if we're going to add more in the next few days. We don't knee jerk to anything. We're not. That's not our thing. I'd rather buy it up at 45 next week after the CMA blesses the deal than, in the pocket. Because at the end of the day, we got into this thing to be 80, 100 plus over the next handful of years. So it'd be nice to buy some at 30, 35, but we're going to take our time and see the next few days how it settles out and go through this stuff with the fine-tooth comb, because there are enough catalysts in the pipe, and we want those to be positive catalysts. So bank balance sheet holds the largest quantity of commercial mortgages set to mature in 2025. So this is going down. Everyone was worried about the refinancing wall. It's getting better. Bottom up consensus, we got that. Hedge fund outflows in the past 8 weeks. They've been selling in the hole. They've been selling in the last 8 weeks. It's usually a contrarian indicator, just like they were selling in the hole in 2022. But I do expect some choppiness over the next 2 weeks. But then again, everyone's expecting that, so maybe I'll be wrong. The good news is I'm not going to make any buy or sell decisions on seasonal factors about what the general indices do. I could care absolutely less. That's why we run our book with very little leverage, so we can just sit through the volatility and usually take advantage of that volatility to add to positions that we love, like some of the ones that we've mentioned. Isaac Newton's Nightmare South Sea stock, December 18 to September 21. This is a great, I had lunch with my friend BV. Thank you so much. in the city yesterday, and his friend Paul, and we were talking about some of the shiny objects out there and things that people are chasing and FOMO genes. And the friend said something like, these people think they're smart. And I said, you're missing this point. The most brilliant people in the world have the same FOMO gene as the poorest people in the world. It's just a different mindset. Some of the greatest entrepreneurs that are on the Forbes 400 act like retail traders because it's not what they do. What made them wealthy, the ones that didn't do it through investing, is massive action and ADD and being nonstop active and interested and taking a lot of bets and a lot of shots on goal. And if you do that in investing, you just wipe out your account. Is basically what it comes down to. But if you look at Isaac Newton, one of the smartest people in the world, during the South Sea bubble, he invested a little bit when it started to go up. Opinion follows trend. He exited. He made a nice profit, okay, like everyone else. And then started to go up against him. All of his friends were getting rich. So he, said, I did fine. I'm going to just... it's fine. But then it kept going up more and his friends kept getting richer. So he put all in after it was up 8x and it went up a little bit more and he probably thought he was a genius, went up another 15%. And then it crashed all the way back down and he lost 90% of his money and died broke. So you have to know history. Charles Mackay, Madness of Crowds, Popular Delusions and the Magic and the Popular Delusions and the Madness of Crowds. That is, I talk about Intelligent Investor. That's a basic book. You should read that for sure. That's a key one. So when you see these shiny objects going crazy and a lot of people recommending them after they're up huge, just do your work. Just say, would I take down this whole business at this price that the market is quoting today with my 100% of net worth? So if you're going to buy a trading vehicle or an actual business that's trading at either valuations you can't justify or prices you wouldn't pay in the private market, just avoid it. Let them all get rich for a year or two, and then in 2 years when they come ask you for a job because they lost all their money, just be humble and gentle because it's human nature. It's really what it comes down to. Don't say I told you so. Don't do any of that stuff. Just understand it's the nature of the beast. GXO Logistics. This came out after they reported and the stock went down. They upheld their $63 price target at Morgan Stanley. They went through all the numbers. Yeah, and it'll work its way up there. I mean, should we have been in the market today? I mean, we added a nice chunk at 42. We're going to see. It's not a position like Baba, which is our largest position, where we're just all in and we were buying like nobody's business. We bought in the hundreds and we bought in the 60s. So we have an 83 blended basis across, a little lower now, across everything. GXO is not that level of conviction, but I think GXO is going to be a nice, beautiful double plus over time. But we don't want to get that percentage up too high. It's not our highest conviction idea like a Baba. But it's a good business. And we want to see who the new CEO is. That's a key factor. And I think it's going to be a good one, knowing Brad Jacobs, he picks winners. Okay. Here's from Elon Musk. Love him or don't love him, whatever you think, it doesn't matter. But what he says here, and his stock market predictions haven't been that accurate in the past, but I will say this. This, I think, is 100% accurate. And he says, as it becomes clear that Doge is working, you will see the long-term Treasury note yields fall. And all Americans will benefit from lower interest payments on mortgages, small business debt, credit card, and other loans. My own addition tied to the longer end of the curve, like mortgages, etc. So you can see this. It's a little higher than this now, up about 50% in a month. On Baba, semi-annual monetary policy report to Congress. I would say we're close, but not there on inflation. Same thing. So that's that. U.S. profits are surprising by the most in a year. We're going to talk about that. Earnings growth, 16.4% in the quarter. Just over 3 months ago, they were expecting 9%. So that's a positive thing. U.S. stocks. This is at 75-year high versus the rest of the world. Going back to the Nifty 50, going back to the internet bubble, you can see all 3 standard deviations. So, these are the things you take the other side of and you make generational fortunes. I'm not saying short it. I'm saying avoid it. And as that money comes out, it's going to go into the safer, more predictable, durable things. Auto loan repayments as a share of after-tax wages and salaries are at or below 2019 levels for millennials and Gen Z. That's not the headline narrative that you see. What else is happening? We've been talking about China ETF is outperforming the India ETF. We said that Japan and India were just hiding the Asian money that didn't want to be in China when they were locked into their apartments and sealed into their apartments by the government. Now that the doors have been broken open, the money's going back to China. Opinion follows trend. India is now near a 52-week low on the INDA ETF. FXI is now up 50% year on year. China versus U.S. tech stocks, this is going to converge. I think it's going to be mostly catch up from China tech versus a catch down from U.S. tech, but I think there will be some catch down for sure. These sooner or later always converge. And then in periods like 2021, you get China gets a little outperformance as well. Same in 2008 and that 2001 to 2007 plus period, etc. Here is high yield credit spreads. This is what you want to watch every single day. If you're a nervous Nelly, if this starts to spike up, then your fears are starting to be a little bit justified. But so far, so good. What do we have here? Earnings surprise, again, well above the mean of 4.4% beat. We're at like 8% earnings surprise this week. So this quarter, which is exciting. We covered the composite. Mag 7 volume warning, starting off with an intriguing eye catcher. This chart shows the 1-year rolling average trading volume in Mag 7 stocks. The concern is that it seems to be doing a similar thing to what it did in late 2021 into pandemic's stimulus frenzy peak. Taken by itself, you might dismiss it, but there are a few other points to ponder this. So you see the volumes are at the lowest level right before the Mag 7 peak in late 2021, early 2022. Sentiment's kind of similar too. Chart pattern's kind of similar too. Doesn't mean it's going to repeat, but if I, gun to the head, I'd say higher probability of a bit lower than higher. It's certainly in the near term. And that's putting it as diplomatically as I can. Net 10-year returns between non-mag, mega cap, and mega cap stocks. So you could see we're back to the level before we had the huge explosion of small caps from 2000 to 2008. Massive outperformance. And then prior to that, this is all cyclical, ladies and gentlemen. From the Reagan era, 1980 to 1985, you saw the same 5-year massive outperformance. I think we're going to see something similar very shortly. Share of clients expecting the U.S. to be the best performing global equity region at the Goldman Sachs Global Strategy Conference in January of each year. The highest. It wasn't even close. 58% of the room think that U.S. is going to be the worst. Take the other, U.S. is going to be the best. Take the other side of that. That's from Goldman Sachs via Mike Zaccardi. Even in the most bullish years, you saw 24 to 32% of the room thought that U.S. would be the outperformer. So it's funny how opinion follows trend. Small caps are trading at a 22% discount to large caps. Again, you haven't seen that since 2001. So I continue to reemphasize this because these points, if you get them right and you execute properly, and for clients, I'm executing on your behalf. These are the times where really special things can happen. And you're getting a taste of that already, and it hasn't even begun. So Fed Chair Powell says central bank doesn't need to be in a hurry to lower interest rates farther. Covered that. Break-even rate is up. This is going to come down, similar to the first quarter of last year. It spikes. First quarter of the year before it spikes, and then it comes down for the rest of the year. Alibaba dramatically outperforming. If you remember, over the months, I said that when the Hang Seng goes, Alibaba is going to at least double the performance of the Hang Seng. That's already happening. You can see here Forget the Hang Seng. It's already 3x outperforming, but even the Hang Seng Tech, it's 2x outperforming, and beginning of great things to come after we just confuse people for the next 2 months is my guess. I'm perfectly happy with it continuing to go straight up parabolic, but I've also been around long enough to expect a consolidation. Consumer staples, no one wanted them. Now they're starting to go. So get some of the laggards. This is very important. And this is something that we're the only ones really talking about and have been continually talking about, is to watch certainly high yield credit spreads, but watch the JGBs, because as those rates go up, the carry trade is unwinding, and all that free carry trade money was in Mag 7, and it is just bleeding out, and it's going to continue to bleed out as their inflation numbers stay up, and as the Bank of Japan hikes rates, the carry trade will unwind, which means the Mag 7 is going to lose that marginal bid, just like Orange County real estate. So that's that. City Economic Surprise Index turning down a little bit, so we'll keep an eye on that. Doesn't, it is what it is. Forward earnings are edging higher. So there's a lot of stuff here, and this is like 10% of what we look at to kind of draw our conclusions in terms of general framework, and then we'd like to look at individual businesses very comprehensively. Businesses that we'd be willing to put 100% of our net worth if JP Morgan was going to finance the rest, to own 100% of the business in the private market. And if you're telling me that you would buy some of these FOMO stocks with 100% of your net worth trading at, 50 times sales or whatever they're trading at, good luck. You might be right. Maybe earnings will catch up, but history has shown that the odds are against you, but not impossible. I prefer to make bets that I can sleep soundly at night when the odds are with me, and do it over some non-correlated bets. So if one doesn't work because of what I don't know that I don't know, the rest well more than make up for it and meet my IRR targets. Nickel back, cost of making American coins. This is mind-boggling. It costs 3.69 cents to make a 1 cent penny, 13.78 cents to make a 5 cent nickel, and then only at the dime do you start to get a good spread. But I don't see how this makes sense moving forward, so we'll see what Trump has to do about that. Buyback and dividend yields. You can see the buyback yield is it's interesting. It's negative on the emerging markets. I think this is going to flip now when you're seeing with the Chinese companies and start to really add an additional level of returns to emerging markets. Bottom up consensus expects an hour. We covered that. Okay, non-farm payrolls. That was Friday. Consumer credit. People are worried about consumer credit. People borrowing a lot. You have to worry about this when it starts going down. When it starts going down, you're getting a recession. When it's going up, it's okay for now. If it stays up in that neighborhood, it should be fine. China consumer inflation picks up as holiday boosts spending. People have been saying China's in never-ending deflation. It will never get out of deflation. It's just not showing up that way anymore, which is good. Europe at a record discount to the U.S. You can see the multiples here, 22 versus 14 times versus emerging markets at 12 times. You tell me. China CPI, you can see the data here, core CPI, that's a sign of health and positivity. The AAII sentiment survey today, 47% of retail investors got bearish, which is kind of interesting. That's usually not where you want to be a seller, but we're looking at this next 2 weeks of seasonal weakness that a lot of people are looking for weakness. And usually when everyone's looking for the same thing, maybe it doesn't happen, but it's interesting to see so much bearishness all of a sudden from retail investors. Just note it. It's just another data point. None of these are foolproof data points, but in aggregate. So this was kind of the big thing with GXO. The guidance was only 240 to 260 in terms of earnings per share for next year, which was a little lighter than 280. Organic revenue growth is going to be fine. We'll do this one in detail next week. We want to spend some more time on it. On balance, it was fine. I'd like to see more free cash flow, but they're largely free cash flow positive, $250 million of free cash flow. So they have all the runway to turn it around. It's a duopoly. It's a European exposed business, which is what I want right now. It meets all the things. You got Brad Jacobs as chairman. He'll figure it out. He's got a lot on his plate these days. So we'll just hold it. And that's that. If it underperforms for 6 months, so be it. When it catches up, it'll be a double or triple. So we're okay with this, but we want to see a couple of these catalysts, the CEO and the CMA, get ironed out in the coming weeks and months. Equal weight versus aggregate S&P 500 annualized 10-year returns from 1970 to 2024. Another way to look at it, equal weight has beat cap-weighted index 78% of the 10-year periods. So what we're in right now because of ZERP is the exception, not the rule. Continue to bet on the exception and face the consequences. Here's the capex. That people are thinking that's a great thing. That's a margin eroder and a buyback murderer. There will be much less buybacks with this amount of defensive capex. Share of sales derived from outside the U.S., that's Mag 7, so they're going to get hit this first quarter because the dollar has been strong. They'll catch a tailwind in the second half when the dollar comes down, but for now, they're going to get hit the most because they have the most sales outside the U.S., so you'll see that in Q1 earnings reported during Q2. Here's the flow of funds, tends to peak right around now, and then that's why you get a weak second half. We'll see if that's the case this year. Second half of February. Q4 earnings growth is actually more than 16.4. Goldman Sachs says 17.1. So a lot of good things happening here, and you can see where a lot of the growth is coming. Materials is still a quarter away from really turning the corner, but healthcare is starting to come up. Financials, consumer discretionary, technology's come down from last year quite a bit from, cyclicals. So cyclicals, that's pretty impressive. 17.6% earnings growth for Q4. Okay. Again, FXI versus INDY, China versus India, ratio chart starting to break out from all-star charts. And that's that for the data. So you can see it's emphasizing a lot of the same points, but as you see them playing out, when we were kind of the only ones talking about them months ago, you can see why it makes sense to pay attention to these longer term patterns over time. Here's CPS. So the thing that is, the stock will probably sell off tomorrow. I was amazed by the free cash flow in the quarter. So they did 63.2 million. I thought they'd be cash flow positive, but I didn't think it would be this cash flow positive. Cash provided by operations, 74 million. That's just absolutely amazing. But it's Q4, and that includes the impact of some of the discontinued divisions. So on balance, this was a good report. Where the problem is going to be is that while they're guiding $200 to $235 million of adjusted EBITDA, their North American light vehicle production assumptions are very low. So remember, we need everything above 15.7 is where we start to just mint money, where all the fixed costs are paid, and like every 300,000 cars is $3 a share of earnings, up to $3 a share of earnings if they don't add costs back, which they say they don't have to. They'll have to add some, but let's just say it's $2 a share in earnings. You get back to a normal peak level of 17.1 million cars. A couple years out, you're looking at $10 plus per year in earnings. Why does that matter? Is because the last peak in 2017 was $7.19 in earnings, and the stock traded up to $146. So I think you have a couple of things going on. Number one, the OEM's margins are going to get smoked because of tariffs and nonsense going on, and they overcharged during COVID, etc. So they have to be humble about their guidance because they're going to be going into negotiations on price. And that's number one. And number two, I think we're going to find that these numbers, these industry assumptions, which they have no control over, the things that they do have control over, they're doing well. Things they don't have control over, if that's true, 15.1, it's going to be probably a cash flow break even or slightly positive year. If it comes in at 16 because what's happening is we're going to do a lot more volume from a lot more incentives at a lot lower margins for the OEMs. And that's the trend for younger people buying cars. They're buying smaller and they're buying cheaper. And then maybe you get a tailwind on car loan rates, et cetera. We don't know. But smaller, same with the houses, you could wind up doing 16 and then this thing just banks coin and it's off to the races and the other thing. So this is one that we will definitely look at in the next week. We'll see what they have to say on the call tomorrow. But the part about their guidance that is not ideal is their industry assumptions about how many cars the OEMs are going to produce. But those are always conservative, and I think that's going to be proven to be incorrect as inventories have to go up, as incentives go up, and as size of the car goes down, which hurts the OEMs because it hurts their margins, but it helps the arms dealers, which is the auto parts suppliers, that have to supply more and more units to support the OEMs. Value stocks are out earning forecasts. There you go. Consumer borrowing surges to 40. We covered that. Japan's household spending massively beats expectations, boosting the case for further BOJ hikes, which does what? Unwinds the carry trade rate hikes. Mag 7 under pressure. Marginal buyers leaving. Bank of Japan's fresh take on labor crunch opens door for more rate hikes. Japan's borrowing costs soar to 14-year high. Billionaire David Tepper built on his everything China bet as rally faded. He's now got 37% of his portfolio in China. We thought we were overweight, which we are, but he's gone cowboy on that. So good for him. The Magnificent Seven companies just did something they haven't. I mean, notionally, with our option exposure, we probably have way more exposure on a relative basis than he has, but we have dramatically less downside than he does. So that's another interesting thing, which is huge. The way we structure for clients some of the long dated out of the money spreads that we made so much money on in October, and we're going to do again in 2025. Kind of, as heavy weight as we are in stock, which is nice for the portfolio, the real juice and alpha comes from our special sauce in that regard. And our notional, like if you added up the amount of stock it represents, it's super exciting. And then our downside relative to that risk is so low and quantified, which is super. Asymmetry is the name of the game. Analysts expect China property market recovery in 2025 after seeing improvement in January. Opinion follows trend. China consumer inflation picks up as holiday boosts spending. Alibaba's Cloud's Qwen 2.5 Max secures top rankings in chatbot arena. We covered this. Better than OpenAI and DeepSeek on many metrics. Here is from Rob Report. Diageo's non-alcoholic spirits are up by 56%, outperforming its alcoholic brands. So these legacy businesses with the distribution in place, they figure it out. They figure out what the customer wants, and then they just jam it through the pipes, and they figure it out. So if you buy them when they're out of favor and you got to wait a year or two for them to figure it out, you make your doubles and triples and move on. Amazon and Alphabet CEOs plan big stock sales. Surprise, surprise. It's not a great indicator, but it's just something to note given everything else we've talked about. Chinese investors drive Hong Kong rally with 19 billion inflow. Tomorrow's newspaper today, ladies and gentlemen. Europe's unloved stocks are suddenly on top of the world. Boeing to cut fewer moon rocket jobs after daily NASA talks. U.S. tariffs will weaken dollar if nations strike back, Bank of America says. They're already doing that. AI's partnership with Alibaba excites Chinese iOS developers ahead of conference. That was the big news this week, obviously, is that Apple is going to use Alibaba's AI across all their devices in China. That's huge because now it becomes the gold standard over there and everything else falls to the wayside. With DeepSeek, China moves to take on NVIDIA's CUDA ecosystem. So, NVIDIA tried to do what Apple did. We talked about this and we said the government's not going to let them build the walled garden that they let happen with the Apple App Store under their nose. That's not going to happen. Well, now the private market is taking that, and used to be you really needed to use NVIDIA software to develop these models. DeepSeek turned that on its head. So did Alibaba Qwen, etc. So Wall Street, UBS to see upside for Chinese AI stocks with rally at less than halfway mark. I mean, these are the same people who were negative in the hole. Now they say it's going to double again. I think they're being conservative. Japan SoftBank swings to a loss ahead of big AI infrastructure bet on Stargate project. Here's the cowboy coming in saying, I got $200 billion. And, this is a guy who blew up shareholders with WeWork. And sold Alibaba in the hole at $70, $60. We probably bought a lot of his shares. And now says he's going to give $200 billion for this. And, he has a $2.4 billion loss in the quarter. He'll figure it out because he's like a cat with nine lives. Some people just have that luck, but good luck. I wouldn't bet on it. At some point, these guys hit a wall. Alibaba shares surged to the highest since 2022 on AI rally. Alibaba pairs with Apple to develop AI features. Okay, billionaire David Tepper boosts China's stake to 37%. Our notional is way higher than that, but our actual real money is way lower, which I love the asymmetry because we can get many multiples of the upside with a third of the risk. Is Intel now a Trump stock? Its shares surge after upbeat comments by J.D. Vance. This was yesterday. And then they followed through today. Stocks up to 24, 25, just getting started in our view. Powell tells Congress Fed still in no rush to lower rates. Walt Disney cuts diversity category from executive pay scheme. When we were pounding the table on the podcast to buy Disney in the 80s and 90s, I would get all these texts and emails and nonsense saying, go woke, go broke. And I never invest on the basis of politics one way or another. I invest on the basis of cash generation, and there's some of that probably hurt them and hurt sentiment and everything else. But that's those days are in the rearview mirror for those who think that's important to investing. There you go. China land sales show property market stabilizing. Chinese tech stock slide as strong rally spurs profit taking. So this is what you see on a day-to-day. They're all waiting for this. So when it pulls back to 1013 or 110, I can't wait to see the headlines from Bloomberg and from my favorite lady over at Barron's, who's been awfully quiet during this 50% rally in Alibaba. So she was super negative every day for 2 years under $100. And now that the stock's up 50%, she's nowhere to be heard, and they have new writers talking about it. But when it pulls back to 112, she'll be back, and she'll be saying, see, another fake out, blah, 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 and there's your contrarian indicator. Intel stock is on a run not seen in more than 2 decades. 3-day rally fueled by hospitable political climate and analyst commentary about its CPU business. I said this a couple weeks ago when DeepSeek was out. DeepSeek could generate similar type of performance with inferior chips. And I said, who is the king of inferior chips in the world? The king of inferior chips is Intel. And it's priced like it doesn't even have chips. So here's what you're seeing. Again, opinion follows friend. And here's Jefferies analyst Blaine Curtis getting bullish after it's had a 25% move. Power moves and power tools stock market and sentiment results. We simply covered in detail the Alibaba news. I would read this article, by the way, showing the double out performance of Alibaba relative to the index, and then talking about all the analysts getting excited and the reasons why they're super excited right now, whether it's the cloud growth, whether it's the AI partnership. And now they're paying attention to it being undervalued, still trading at only 12.2 times forward earnings. No, not 12.2 times sales, 12.2 times forward earnings, ladies and gentlemen. And maybe we'll get, they'll take guidance down a half a penny, and that'll get the stock down to 110. And then the multiple will be down to 12, and people will say, see, and then at 200, they'll be buying it hand over fist. Just like Mr. Isaac Newton with the South Sea bubble, selling at the wrong time and buying at the wrong time, not because he was dumb. He was one of the, if not the smartest person in the world at the time, but because it's a different skill set. And that's all I can say. Here's Generac, same thing. You can see free cash flow recovery. Stock, under 100, no one wanted it. We were table pounders. at 200 or at 190, everyone wanted it. Now it fell back down to 150. No one wants it. Bottom line is the cash flow is recovering to record highs, and it just printed record high free cash flow. Penetration rate is low. Disruptions from weather and demand on the grid are going up, not down, and rates will slowly come down, and new houses will slowly go up, and this will be a monster beneficiary. The big two, by the way, the title of this, and Jeff did an incredible job, should have been two best levered plays on housing recovery. I was looking at some home builders today, and they're down a lot, but they've been up a lot. So I wouldn't really get excited about buying home builders in the hole yet. I think they probably have some more pain, and as the numbers start to improve, I think the price is still going to go lower for the home builders, just like you saw with Alibaba. But I think these are the two best ways to play a housing recovery. Massive units, smaller size units, smaller footprint is going to be Stanley Black & Decker, and Generac I think are going to be huge. So you can read all the reasons why here, and then you could also read same thing with Stanley Black & Decker, destock to restock, just waiting for the housing units, and this will be off to the races, construction, etc. But free cash flow, you've got runway. This is all you need. All you need is runway. Price is going to be price. It's going to hover around between 80 and 110, and then the game is going to be on, and the thing's going to go straight back to new highs. And it's going to take a few years, and your IRR is going to be 30, 31% on the investment, and it all came in the last 6 months. And people will be like, oh, yeah, that happened. Actually, it's funny. I only hear things before they work. After they work, it's crickets. It's unbelievable. When Alibaba was down and I'd post something about Alibaba, I'd get like 400, likes. And now that it's like gone up 50%, everyone's crickets. Why? Because they sold in the hole. They got tired of it. They got pushed out of it at the exact wrong time. They couldn't hold on, and now they hate that it's up so big. So, maybe they'll buy some at 110 or whatever when they could have bought at 70, but that is human nature. Except for the people listening to this podcast who are awesome and are learning some of these tricks of the trade and doing great. And I also hear great things from them as well. So here's the existing home sales. This is a great chart that Jeff included, and it just shows we're kind of just getting started here for the next cycle. Houses are going to be smaller, units are going to pick back up, and Generac and Stanley are going to be huge, massive levered plays, and they have all the runway. So if it starts right away, if it takes a year, if it takes 2 years, as long as you have free cash flow on the balance sheet's okay. You just wait it out, and when it happens all at once. He did a chart on EBITDA. We don't talk about EBITDA on this conference call, so let's nix that moving forward. But the concept is the same with free cash flow. You're seeing the recovery, and I like the theme. Intel, so he covered that. You can see the price down because the business is down. Again, next catalyst for them, just like GXO, new CEO. We got a little bit of policy tailwind. Maybe we'll get a little policy tailwind on GXO. As far as Cooper Standard, I like buying on the weakness here because I think the industry numbers are too low. And I think management is also going to be conservative or negative on the call tomorrow because the OEM's quarters were crap in terms of profitability, great in terms of units. So they don't want to say, hey, we're making all this money while, GM and Ford and Stellantis are cutting costs and laying off people because they paid too much to the union. So that's that. That'll create another opportunity, particularly for new people to finally get a real size position. Will be great. Many of you listening to this have bases in the $5 when we started buying in March of 2022, and $8 and $9 across everything. So hopefully we can get a bunch at 12 or 11 or 13. It's going to depend on tomorrow's call and liquidity, but it's all noise. This cycle repeats itself every 5 to 7 years, and we'll get the US SAR and they will mint money. Vance also mentioned other touchstones of the Trump administration, saying that, quote, to safeguard America's advantage, it will ensure that the most powerful AI systems are built in the U.S. with American designed and manufactured chips. Well, the only player in town, they can bring TSMC over here and they will, but the only player in town is Intel, and they got to make Intel work, and that's how it's going to be. Maybe they'll put 50% of the equity in the sovereign wealth fund, but if they make this thing work, it's going to have a U.S. monopoly is really what it's going to come down to, because Trump's going to push them to do all their orders through Intel, particularly if the sovereign wealth fund and the taxpayers hold it. I I can't tell you whether this sovereign wealth fund is going to happen or not. It doesn't reek of proper capitalism, but I wouldn't be surprised. So there you go. And you can read through all this great detail that was highlighted for you. Again, CNN fear and greed is fearful. It's kind of neutral here. Not an area where I want to buy everything or sell everything, to be honest with you. I'm just paying attention to the seasonality. NASDAQ top 30 weights earnings estimates in the last 60 days. Down 19 basis points, so basically flat. Dow, same thing, top 30 weights up for next year, 55 bips. Down for this year, 71 bips. So again, flattish. Here was 16.4. That was last Friday. Goldman said we're at 17.1. Thing I want to keep an eye on is the seasonal tendency is that guidance comes down in the first quarter every year, and we are in fact seeing that, down from, we were basically at 275 all year, and we're now down to 272. Interestingly enough, 2024 is finishing up much better than I anticipated. So don't be surprised by a hockey stick in the back half, getting back up over 275, 280. That's earnings. We talked, PPI was better than the CPI, but again, seasonally, this has happened every January and some Februarys in the last few years, so don't make too much of it yet, particularly with all the people that are getting laid off with Doge. And let's get down to the Ask Me Anything questions. For those of you who get value from the Ask Me Anything questions, stick around. For those of you who just like the podcast, we kept it here to a reasonable amount of time. We'll see you next week, same time, same place. So, question number 1 comes from JT Investor. He's asking about the guidance with CPS. We covered that. And that's just a function of the things that they don't control, which is industry volumes, which I think are way too low as they have been. FactSet says over the last 5 weeks that Q1 earnings and revenue are trending down. So that's normal. Guidance comes down the first quarter. We covered that last week. It seems GXO won't reach its 2027 goals. Their organic growth, low single digits versus double digit. Does this change your view on the company? No, it just extends it. So it's going to hurt my IRR in the short term unless they get a great CEO and they get the CMA thing approved. It's just going to take a little longer, which will give me an opportunity to probably build the position a little bit more. But we're not doing anything yet and haven't decided whether we are. We're comfortable with our position as it stands. Henry Bashari wanted to say thank you. Your framework has given me a guide on how to handle my emotions. I used to panic when positions fall, but now I know that as long as I've read through the noise and I know what I need to do. Appreciate your teachings and wish you all the best in life. Thank you, Henry. That's very kind. Brian Norman. Are you backing up the truck on GXO? No, not yet. That may change tomorrow, but I'm comfortable with the position. And just because something happens to a stock, most people, the stock beats earnings and the stock goes up and everyone has to chase it up. And sometimes it keeps continuing and sometimes it's complete fake out. And then just the same, it goes down. Usually you want to wait 3 days anyway. Number one, to take some time and think about it. If they had the best quarter ever and it went to 50, would I be buying more? And the answer is no. So because my basis is a lot lower. So I'm going to wait for it to settle out. I'm going to do some more work on it over the weekend. And I'm perfectly comfortable doing nothing and letting it go lower before it goes higher, or letting it go higher and I missed the day to add a few shares. It doesn't really make a difference to me. It's not the highest conviction idea in the portfolio. And if you saw how much I was buying in one day when Baba hit 58 that one day and the high 60s, that would blow your mind. All right, here's a question from Warren Buffett. You guys can verify if this is a correct, authentic email address. It says warren.buffett.third@gmail.com. Hello, Tom. Thank you for all the great time in your show. Even at my age, I am still spying on your tips. Check this out. For me, my eyeballs are getting tired. Archer, Daniel Midland, and FMC Corporation. Thanks, Warren. Okay, Warren, let's see. I'm not the guy to be giving you advice, but you could ask your son about Archer Daniels Midland, because A, he's a farmer, and B, I think he's still on the board. We've covered this one a lot. I do like it. I've got an alert. If it gets down to 40, I'll probably start to buy it. You say, well, what's the difference? Why not just start buying at 45? And the answer is we don't really have room for it right now, and there's nothing I'm willing to sell to make room for it. But yeah, I got my eye on it. But let me just take a look at the financials, because I think we did this one and I wasn't that excited. Yeah, free cash flow had been going down, revenues had been going down. So I'd have to listen to a bunch of calls and find out what the turnaround plan is. But yeah, you're seeing this across all the ag space, FMC. This is why there's always something for us to do. I know we've been pounding the table about the window for the destock restock cycle is closing, and a lot of those names have run or are running. But there's always stuff to do. FMC, similar type of thing. I like both of these, but we're not buying them yet. But we would definitely want to be doing work on both of them for sure. Because when they turn hard. They're cyclical businesses. They're not really owned forever businesses, but this one is turning around. FMC, we got to see a revenue start to turn around and understand why it got hit so bad. But you're seeing it company by company. So yeah, I definitely like this space. Thank you, Warren, for your great ideas. And by the way, for changing my life, even though you're not the real Warren Buffett. Mitch Lim, is there an opinion on Twitter stating that the positive correlation between HSI and HSI volatility index means that U.S. hedge funds are likely manipulating the market? Mitch, this is the biggest amount of bullshittery. Just forget it. What does that have to do with the amount of cash that Alibaba is going to generate over the next 5 years, being the leader in AI, the leader in cloud, complete toll taker on the recovery of the middle class? Stop wasting your time reading bullshit that is completely useless to making money. But thank you for the beautiful question, because I'm sure that helped a lot of people. And thank you for being a great listener. Chris Williamson, take a look at ATAC. Good medical device opportunity here, inflecting on profitability. Could be a strong year for them. Let's take a look. This thing has really negative free cash flow. This is a no-no for us because they don't have the runway. So I'm going to pass, and I'll take a look. If you want to ask again in a couple of, if they start to print some free cash flow, then let me know. Actually, let me take a look at the quarterly here, even though I don't really love looking at quarterly. Oh, what happened here? Anyway, it's not for me right now, but I'll keep an open mind. Thoughts on Pepsi? We've covered this a few times. Staples, the whole thing. I like the protein plays like Hormel. I think this one's okay. I wouldn't get excited about owning it, but I know the GLP-1s, etc. That's why I like the protein plays. Dividend Aristocrat. I'd probably be interested around 135. I'd take a close look. You don't get too many chances to buy this business like this. So yeah, I think it's almost time. I think it's a little early. And but I generally like the idea, but there are some different headwinds that didn't exist. So you got to be open-minded. And that's why I need the price to be a lot lower, like Diageo low on that basis. What do you think about Vistry Group? British home builder, 40% return on capital employed, 10 times earnings. I don't know the British housing market well enough, but let's take a look. Vistry Group. I do want more exposure to the UK than just GXO. Yeah, I would listen to the call. I did see some stuff about UK housing that wasn't good this week, but let's see what this looks like here. VTY.L. Yeah, I mean, this is going to be similar to the U.S. home buildings. It's just going to take a few years, probably a year or two to bottom out, or even more. But I think you're early, and I think you're right. But I think you're going to have other opportunities. Let me just take a quick look at the financials and see if it's worth just putting in a flyer now and just waiting through the next year and a half. So it looks like they did some acquisitions. What's this negative free cash flow last year? Wait. I guess they didn't report 2024 yet. Let's take a look at quarterly. Yeah. It seems like it's turning the corner. I would do some more work on that. I think that's kind of interesting. It's always been a pretty low quality business. That tends to be the case with home builders. Income statement. Yeah, they're buying in. Wait a second. No, they're diluting. They diluted shareholders by a lot, probably for that deal. I don't love it. I'd probably take a few minutes to look at it more carefully, but I think you got time, and I think it's a good find. So let's go there. All right, Don L. Estee Lauder has 2 share classes, and there is no direct way to influence the company as the family has majority voting rights. What are your thoughts on this class structure? I love it when it's family owned, just like Walmart was when they were in the dumps because they didn't have their internet strategy. The families fix it, and they fix it quickly. I love that. The other thing, too, what you have to keep in mind is go ask your 10 and 12-year-old nieces or daughters. Everyone thinks that Estee Lauder, first off, Estee Lauder is basically a China recovery play. And I think the recovery is going to be fantastic. But even, most people think in the U.S. that it's just a bunch of old ladies that are dying off and it's never going to come back. When I talk to the makeup people at Fox, they're just like, they own so many great brands. I mean, if you ask your young kids, they'll talk to you about Dr. Jart Plus. They'll talk to you about, I think, Lab Series. And I think The Ordinary. And I think Too Faced. Origins. You got MAC. So they're going to figure it out. They've been trading portfolio brands just like VF Corp for over a century. And family-owned businesses, the beauty of them owning 38% of the company is that they've got a lot more to lose than we do. If they lose everything. If we lose, our 2 things when we buy a company are, number one is if this position were to go to 0, because there could always be something that you don't know. And if you think otherwise, you're not being rational. Would they take us out on a stretcher? And the answer is always no. It could go to 0 and we'd be fine and we'd be able to outperform over a reasonable amount of time from the remaining companies in the portfolio. That's number one. They can. If they lose this, chances are 4th, 5th generation, they can't go out and try out for the Mets and make a living. So they're going to make sure they have the right people in to turn it around. You got a new CEO that just did the kitchen sink quarter, which is why it was down a little bit, which happens every kitchen sink quarter with a new CEO, first quarter, etc. So I'm not worried about that. I'm pretty confident in China, and that's really the whole trade there. And it's a smaller position. Obviously, our highest conviction China is Baba. Could you take a look at YMM, Full Truck Alliance? I don't buy smaller Chinese companies because I operate under the assumption I'm not willing to take company and country risk. And so this probably works as a trade, but it's too small, too unknown, too unproven for me. Probably works, but I'm more than willing to miss it. My general premise with Baba was always that if if Baba goes, so does China. So I don't have any worries about fraud, or much less than I would with something like Full Truck Alliance. I know the company, I know the numbers. It's fine on paper, but you can't trust the paper. That's the problem. So I'll leave it at that. PZZA. We cover this pretty much every week, and every week I basically say, don't love it. It'll probably work. And my answer this week is probably going to be the exact same thing. So it's starting to move. Probably take a little bit longer. So you'd probably be able to buy it at 45 if you really love it. I think that I don't love this trend of cash flow rolling back over, but I think it's probably priced in enough. But I've continued to say, it's okay. Brian Wilson, do you think Trump's executive order revoking electric vehicle mandate will have any negative impacts on Albemarle? Yes, that's why the stock's down. Everyone knew that. That's not news. So the whole story here is 40 million global stock to 120 million by 2027, all driven by China, fake subsidies, and the normal cyclicality of the lithium business, them being the top producer with $3.5 billion liquidity runway to wait for the cycle to turn, and it will. They've all cut production, and it will come back. So there you go. Lucas Bergman. Any semiconductor picks besides Intel? No. Matthias Bosavart. Met coal. I've seen a lot of people do that and lose a lot of money. So I would say this is an example of like, yeah, of course, Trump doesn't care. Like he wants all energy, which is true. But if you bet that way, you got smoked in his first. Which one are you talking about? Alpha Metallurgical. All these things just restructure every few years, go bankrupt, flush the shareholders, come back out, go straight up. Everyone thinks that they're great businesses. Alpha Metallurgical. I don't even know. I like the contrarian thinking, but I don't want to play there. It's a trade. Let's see here. AMR. So it's up 125x, and now it's pulled back 50%, and you want to buy it here. I think we covered this one before. It looks familiar. So the answer is no. And then Jay Apt, what is your process to get DG? He's asking about. We're not doing anything with DG, but we're keeping our eye on Dollar General for sure. These have been smoked by Temu. If that de minimis comes back, I think this and Dollar Tree and everything else are going to be pretty good opportunities. Yeah, they'll shut down a lot of stores. You got to get a sense of solvency risk, but I think they've got enough assets that they can sell off and cash flow. Let's take a look at the balance sheet. $500 million of cash, $6 billion of debt. So they'll probably have to close a bunch of stores. I mean, this is a levered play, so you really got to keep your eye on free cash flow, because that's going to be your runway. And even through all this, it looks okay. They're going to, it's just, the issue with this one is that it's basically the same play as Advanced Auto Parts, and I like Advanced Auto Parts better, and I like the guy turning it around better, so I don't need two of the same thing. It's basically retailing to lower end, and I just think the necessity of what Advanced Auto Parts sells and the areas where they control the market is a much better moat than, selling cheap candy to people who shouldn't, to whatever. It's just not as good of a business, but I like the idea. Can you take a look at Ashland? Okay. Cash flow is turning down with price, so you got to get some comfort. I don't see revenues recovering yet. Margins have been choppy. Let's take a look at the balance sheet. $300 million of cash, $1.35 billion of debt. It did have a pop of free cash flow. How's that doing on a quarterly basis? This has always been a pretty low quality business. Let me just see here. Specialty ingredients. Special, yeah, all these are down, like international fragrances and flavor, Darling, what is this? Soluble tablet binders, nutrition solutions, thickeners, stabilizers, emulsifiers. I think if it gets in the low 50s, start to do some more work, but let me just see something here. Analyst, financial income statement. See what they're doing to the share count. All right, so they're not increasing the share count. It seems like a cyclical business. Yeah, it's probably getting close to okay. I need to do a lot more work and listen to management and understand that. But like, if you can buy this at 50% off, which is not there yet, it's probably kind of interesting. But it's not a great business, so it's more of a trade, which is why I'm a pass. Alex, Evolution AB. We cover this one very often. I don't like this casino gambling business. It's just too unpredictable. This is online. They can go when they go. They go. Yep. This is. We'll take a quick look at it. Evolution AB. Yeah, I mean, everything looks great on this type of business until it doesn't. And I've seen these cycles come and go. So maybe this one's different, but you got to tell me why. And that takes a lot more work than doing a few minutes here. Yeah, I think this is more of a trade. I think a lot of the juice is out of this lemon, but you could definitely get a spike up to, 130 or something like that. But it's not for me. All right, Jimmy Jones again. Does share dilution bother you on Intel if they do it at a low price? Yes, of course it bothers me. But if they stay in business, they will be able to start to generate cash and buy in shares, and they will stay in business. So that's a risk, but I think a lot of that is actually priced in. I'm not sure if you smoke, but I got a potential cigar butt trade for you. Don't smoke, Keshav, but let's see. GPRO. Yeah, I know there's a big name in this. I never no, not for me. Pass. good luck with smoking causes cancer, so just beware. Jason Zen, not seeing what Bill Ackman is seeing in Uber now that he's taking a 1% position in the company. It's not what we do. I'll leave that one to Mr. Ackman. But, I mean, you really have to, obviously Dara's done a good job running the business. You have to have some view on what's going to happen with autonomous and how it's going to impact them. And this falls into the predict the future category, which, on the one hand, is possible, but it's not probable. And I think things are going to change so much in this space. So he's kind of got double exposure to autonomous between his position in Google and his position in Uber. I don't see anything wrong with it, but I don't want to own it. It's just outside of the lane of our lane of competence and what we do well. So I'd be way more interested when I was at 25.30 than I am right now. Doesn't mean it doesn't go to 200, but it can do so without us. And I'll leave it at that. Elliot. Okay, so with that said, I want to thank everyone for tuning in. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.